Let's clear something up real fast. We are not in a recession right now, but you would actually never know it. The headlines are screaming. Your group chat is nervous. Even your barista has an opinion. Mortgage rates are high. Heck, eggs cost more than your car payment. And everyone's acting like the sky is falling. So you're probably wondering, isn't this the worst possible time to buy a home? Totally fair question. But here's the twist. What feels like chaos might be your once-in-a-decade shot, because recessions are coming. They're always coming. That's how the economy works. They're not rare. They're not a death sentence. And when it comes to real estate, they can be a gold mine if you play it right. So what's really happening? Well, right now, the economy is in a very weird place. We're adding jobs, unemployment is low, and GDP is positive. Those are not recession signals. However, credit card debt is rising, inflation is cooling, but still very sticky. Consumers' confidence, wobbly at best. And mortgage rates, well, let's just say they're being stubborn and not exactly offering the let's go buy a house energy. So while this isn't technically a recession, there's a vibe shift. And that uncertainty is causing a lot of potential home buyers to hit the pause button. Which brings us to, well, here's where it gets very, very interesting and where most people get it 100% wrong. When they hear the word recession, they immediately think of 2008. Foreclosures, price crashes, and total chaos. But that was the exception, not the rule. Many people think the Great Recession caused the housing crisis, but that's wrong. Ultimately, the housing market crash contributed to the onset of the Great Recession. That crash was caused by the housing market, and it was largely due to bad lending practices, which don't exist today, zero doc loans, which don't exist today, and inflated property values, which don't exist today. In most recessions, home prices held steady or even went up. Check this out. During the 1980 recession, prices rose more than 6%. In the 1981 recession, up again. During the 1991 recession, home prices changed downward under 2%. In 2001, home values climbed over 6.5%. Even during the COVID recession of 2020, arguably the shortest and the most bizarre recession ever, home prices skyrocketed 6% due to low rates and low inventory. So no, a recession doesn't equal housing crash. In fact, if you're smart, it can be your competitive edge. Here's 4 Kevin Martini reasons why smart buyers should love recessions and recession-like environments. At number 4 is the fact, during a recession or during periods of uncertainty, fewer people shopping means less competition. That's simple. At number 3, homes sit longer, which equals negotiating power. At number 2, sellers get more flexible. This means you can think of price cuts, credits, and concessions. And at number 1, there is a less chance of a crazy bidding war that pushes you over your budget. Here's the punchline. In hot markets, you're reacting. In recession-likely markets, you're strategic. This is when calm, well-prepared buyers can make moves others are just simply too nervous to make and often get better deals because of it. This is significant because in real estate, money is made when you buy, not when you sell. Let me say it again for the people in the back. In real estate, money is made when you buy, not when you sell. Now let's talk about the mortgage elephant in the room. Interest rates. Yes, I'm going there. Interest rates are higher than we'd like. It's not ideal. No one's throwing a confetti party over it. It's kind of like going to your favorite restaurant only to find out that that price fixed menu is double what it used to be and the portions are smaller too. You're not thrilled, but you're still hungry. You still need to eat. Here's the real talk. Higher rates don't mean it's a bad time to buy. They mean it's time to get strategic. Because if the payment works for you, if it fits your life, your budget, and it doesn't keep you up at 2 a.m. wondering what the heck you've done, then you're in a position of power. Rates go up. Rates go down. You can't control that part. But what you can control is locking in the right home, in the right market, in the right neighborhood, with the right terms right now. Waiting around for perfect conditions, that's how people miss out. Because while everyone else is hoping and refreshing rate charts like they're watching Game 7, you could be making a smart move, one that puts you ahead when mortgage rate market shifts again. And it will. Will you have the option to improve your rate down the road? Most likely. Maybe even maybe. But here's the point. You can't refinance a missed opportunity. If you're buying during uncertain times, don't wing it. Work the plan. Start with what you can comfortably afford, not what the lender says you could qualify for. Look for seller signals like price reduction, longer days on the market, or homes that fell out of contract. Heck, I think a for sale sign on the lawn is a signal too. Leverage negotiations. Ask for closing costs, rate buy downs, or home repairs. It's about long-term wealth and stability, not getting in just because rates might change. If you need to sell right now, don't panic. But don't wing it either. Today's buyers are cautious, informed, and picky. You can't just throw a listing online and hope for the best. Make sure you price your home right out of the gate. Don't go crazy with those improvements either, but make cost-effective improvements like lighting, paint, and my personal favorite, curb appeal. Don't forget to stage it, market it, and work with pros who understand buyer psychology today. The goal isn't just selling. It's selling smart in a slower, more thoughtful market. Now let me go shift back to the home buyers. Here's something I'm hearing more frequently. But Kevin, what if prices drop after I buy? That's a fear, isn't it? What if you buy and values dip for a bit? Here's the mindset shift. Real estate isn't a stock. It's not about timing the minute. It's about owning the asset long enough. Historically, home values trend up over time. And while you can't guarantee short-term appreciation, you can guarantee long-term stability and equity building. Let me share a Kevin Martini bonus stat. According to the Federal Reserve, the median net worth of a homeowner is nearly 40 times that of a renter. Think about that. It's not just about the value of the house. It's about the discipline of paying into equity instead of rent. Let's look into this foggy crystal ball for a second. Inventory is rising, giving buyers more choices. Rates may cool slightly, but probably not crash down anytime in the immediate future. Home values are expected to increase modestly over the next 12 to 60 months. And while a true recession might arrive, we are far from crisis scenario. The market favors people who make moves with a plan, not people who sit frozen, hoping for the perfect moment. Spoiler, it rarely shows up when you expect it. So, should you buy a home during times like we are experiencing today? Maybe, but only if you know your numbers. You got a real strategy, and you want to stop renting and start building long-term wealth. A recession or fear of a recession isn't a red light. It's a yellow telling you, slow down, cowboy, get clear, and move forward with intention. Because the ones who win right now are the ones that are intentional.